Right.
All right. Hello, everyone. This is Paul and
Jason Martin.
Paul and Jason with AllGen Financial. Welcome to our quarterly update and market review. Today's July 20th, 2023. And we're excited to bring you our thoughts on what's going on in the economy, what's going on at AllGen, as might be relevant to you. It is summertime, so this is always an interesting session because some people are in a vacation mode. I just came back from vacation mode, so I'm getting back acclimated into work mode. But we've got some good information ahead as far as what's been going on and what we see going forward. So I want to quickly just jump into the webinar as people are joining in, let you know what we're going to be talking about today. Introduction is obviously, you know who we are, but at the same time, we always like to start off with some polling questions. One, to break the ice, get you guys involved and engaged. Usually one is not financially related at all necessarily, and the other one is a little bit more financially appropriate. Then we'll obviously have Jason jump into the market review and the outlook, and then we'll give you some updates of what's going on at AllGen. And of course, fun part of this is the Q&As. So with the Q&As, please know that you can ask questions anytime throughout the webinar. Just type them in, hit the Q&A at the bottom and type them in. Do not raise hand, that feature's turned off, okay? But you can type it in anytime during the webinar. We're gonna reserve the questions till the end, and I promise we usually get through most of them, if not all of them, unless I find that some question that's asked is very specific to something Jason's mentioning at that particular moment. I may interrupt him to ask that question. But for the most part, please feel free to pop in questions, populate that Q&A box with any questions you may have, of course, financially related, and then we'll go from there. So that being said, let's jump right in. I'm going to start with some polling questions. And the fun question of the day, you know, the World Cup, Women's Soccer World Cup begins. Okay, I think it's today. But question for you, what team do you think will win the Women's World Cup? Some of us may be biased, some of us may have no clue, but we chose the 5 top expected ranked teams in the world. So we've got United States, Germany, France, England, Sweden, but of course the catch-all, if you are really biased towards another team, you can just choose other. So let's get going with that. I'll give you a second to answer which team you think is going to win the Women's World Cup. And do the Jeopardy music. Okay, here we go. Let's see what the answers are. And it looks like a resounding United States is what we feel. Actually, we've got France, England, and the other were all tied. So that's interesting. Okay, very good, very good. All right, so let's jump to our a little bit more financially appropriate question. And this one is a little bit different. This one we want to hear from you, not so much in what your opinion or speculation is, but really what is important to you. We want these webinars to be relevant. So what would you like to hear more about from AllGen in these webinars or in our marketing material or educational material, our blogs, etc.? We have economic updates or market updates, which is what we do here. We do these live, but we also do blogs every month that you've probably seen Christina or Ryan put out, or Jason. Retirement planning. I know with the baby boomers retiring, that's a big concern or a point of interest. Debt management, debt elimination, etc. Tax strategies or minimizations. Estate planning, making sure you have your wills and trusts in place, okay? Or Social Security and Medicare, again, with the baby booming and retirement. Retiring America, Social Security, is it going to be around? Are there strategies to maximize that with, coordinating that with my 401k distribution, etc.? So I'll give you a second to answer what would you like to hear more about? And of course, it's not exclusive, although it only allow you to pick one for this webinar poll. But let's see what people said. Economic updates are of interest and retirement planning. Again, we have some Social Security as well. Very good. We'll make note of that and keep that in mind as we put information out. So again, please feel free as the presentation is going to ask any questions in the Q&A. And with that said, I'm going to turn it over to Jason. Take it away.
All right, thank you, Paul. All right, well, to get started here, like Paul said, it's July 20th, 2023 for recording purposes. And I'm just going to jump in here to kind of give you a landscape of what the market's been doing so far this year. It's been a pretty interesting one. We show these kind of 4 main indices here: the S&P 500, which is your large U.S. companies; the S&P 600, which is your smaller cap U.S. companies; And then we have the MSCI All Country World Index, ex-US, that would be your international and emerging market. And then you have your Bloomberg Aggregate Bond Index. And so as of right now, the S&P is up 18%, international is up 12%, small caps are up 10%, and bonds are up 3%. But what's interesting about this chart is that along the way, you've had multiple different things lead. So to begin the year, this section right here, international led, and then you had small caps lead in this section right here. And then for a very small period of time, you actually had bonds lead when you went through the banking crisis. And then, as you can see here, international led again, and then finally, over the last few months, the S&P and U.S. stocks have started to take the lead again. So that's kind of been the landscape so far. Definitely a welcome sign compared to last year. All asset classes are up this year, contrary to last year. So, all right, well, let's jump in. So a couple other things here that we're seeing, looking at the S&P 500, which is kind of your general broad measure of the U.S. stock market. And a couple of technical things of interest here. So you had, if it would just kind of go rewinding here for a second, this is the big drop over here of the pandemic. And then you had a big rally in 2020, 2021. And that peaked at that bull market peaked at the very end of 2021. And you started the bear market that we were in last year. And you can see that actually bottomed in October of 2022. The S&P was down 24% at that point from its high to low. But then you can see at the beginning of this year, you broke that trend line right here, came up, and then went back down and tested that trend line. A lot of times in technical analysis, when you break a resistance trend line, you'll go back down to it, and a stronger market will test it one more time and hold on to it, not go back below that line. So that happened. And then now, just recently, we've broken into new one-year highs. So technically, we are in a new bull market. We're up more than 20% from the low. Also, textbook uptrend, you have higher highs, consecutive higher highs, and consecutive higher lows from there, and then you have a little one right here. So we are uptrending again, and we are now back into a bull market. A lot of times, it may not feel like a bull market. That was the point that we were trying to make in our last quarterly webinar, where you had so much negative sentiment around October and even the beginning of this year. Most bull markets start with a lot of skepticism, and then they continue. There's a Wall Street adage that says that the market climbs a wall of worry, and when you have that kind of worry, that's actually sometimes a bullish thing. So that's what the S&P 500 looks like. Definitely looking a lot better, breaking into new one-year highs and now in an uptrend. Small caps have actually lagged this year, but they are starting to turn a corner as well. So you can see this is the high, same time, actually started a little bit earlier in kind of November of 2021 was its peak in the bull market, same kind of 3-year time frame here. And then a longer downtrend, but it also bottomed in October last year. And we just broke this resistance trend line right here, and see if it will. The jury's still out if it's going to hold that, but we are testing it right now and trying to break it. So that could be a welcome sign, because up to this point this year, I'm going to show this on another slide, large U.S. companies have really been leading the charge, especially what's called the mega caps, or the really big names, Microsofts and Googles and Amazon, especially the tech names. Those have been the leaders. But now you're starting to get a little bit more breadth, and which means a lot more of the market is participating in the upward trend, which historically is a bullish sign. So now this is an interesting chart, because it was the exact opposite of what it was last year. You have the the S&P 500 is what's called market weighted. You market cap weighted, excuse me. So that means like the larger the companies become, and the market cap is the size of the company, the bigger percentage it becomes of that index. So like an Apple that's, it has a market cap of $3 trillion, or Microsoft, very similar, Amazon, those become really big weightings of the S&P 500. And right after the banking crisis, kind of in that March timeframe, you started to see a separation between the market cap weighted, the regular S&P 500, and then what's called an equal weight, where it's basically the largest 500 companies and they have the equal percentage of each holding. And up until June, you can see here the S&P, if you had all 500 companies were equally weighted, was actually flat, while the market cap weighted was up 10%. And what that means is you have these like gigantic companies that are really leading the charge. The large, growth companies, which were down 30% last year, are now leading the charge going forward higher. A lot of times you would like to see a little bit more breadth, which means you want to see the other companies, not the stock market, not just led by a few companies, but the entire the entire market kind of going up at the same time. That would show strength. So we're starting to see a little bit more of that now. In the last like month and a half, you actually have the market, the equal weighted, the rest of the stocks doing a little bit better than the S&P 500. So that's a welcome sign. And this is what I was talking about. You have kind of these few sectors, technology being the main one, that's really leading the market here. So these are year-to-date returns of all the different sectors, and it's a complete swap of last year. So technology was the hardest hit last year. It's what's done the best this year. You have a lot of people are coining this as the AI boom right now that you're seeing in technology. So communication services that can also have a little overlap with technology, and then consumer discretionary is kind of mostly the bulk of that is Amazon and Tesla. So some of those stocks that got hit the hardest are now going up, and that's really what's kind of leading, where you have kind of your healthcare, utilities, your energy, the things that held up best last year that are getting hurt the worst this year. So almost a complete flip from what we saw last year, which this slide right here points out. So in 2022, this little matrix just breaks up the US stock market into 4 different categories. So you have your large companies and your small companies right here, and then you have value and growth. You can see last year value, especially large cap value, was down 29%, where your large cap growth was down 29%, where your large value held up a lot better. It was down only 7.5, still down, but held up 22 percentage points better last year. Well, fast forward to this year, so year to date, same matrix here, large cap growth now up 31%. Large value is definitely trailing behind. It's up, but it's only up 6.7. And then you can see in this scenario too, small caps, for the most part, are really underperforming large caps, but that seems like that's just now starting to change. So a complete flip from last year. And that's why, we think it's important to be an active money manager, which is easier said than done, but at certain points you want to try to overweight, certain areas that you think is going to hold up better. Like last year, we were really overweight the large value and value in general, which held up significantly better. But then you have to be ready, and this is the difficult thing, to flip back to the next area that you think is going to do better. And at the beginning of the year, we were very heavy value, and then growth started really outperforming again. We missed out a little bit on those first couple months, but now our portfolios have kind of gotten closer to evening up, if you will, equal amounts of growth and value. And so that started to help our portfolios over the last few months, really since March. This is a line chart. Basically, it takes value divided by, so the Russell 1000 value divided by the Russell 1000 growth. And it's a way to visually kind of display something that I just showed in the last chart, where you can see if the line is going down, growth is outperforming. If the line is going up, value is outperforming. I wish we had a chart that went back 100 years, because over 100 years, value has actually outperformed more than growth. However, really since kind of 2007, 2008 timeframe, you've had growth significantly outperform. But that was not the case last year. So we broke this long-term trend line last year, where now value started to outperform in 2022. However, to flip this year, we went back and broke again to the downside. So now growth is starting to outperform again. And this will be something interesting to watch. I don't know if we're going to continue to have growth outperform. It seems like that's the case right now, but we're eventually going to get back to, over the next few months, testing some of these other lows here and this trend line again. So that's something to keep an eye out, if growth will continue to outperform, or if value will start to take the lead again like it did last year. So a lot of things are looking good in the stock market. Just specifically on the stock side, you have a lot of trends breaking out. I showed the S&P 500 hitting new year highs, showed the small caps hitting new year highs, breaking a trend line, starting to look better. We've also seen breadth as a whole, a lot of stocks starting to participate again. That's usually a very bullish sign. But the one thing that I would caution people on is we're going into a very seasonally weak time period. So what this chart looks at is what the average return over the last 30 years, what's been the average return of each month. So January, February, March. And then you can see for the most part, the first half of the year historically has been positive. But this time frame, which we're entering right now, August and September, are historically the weaker time periods of the year. And, so on average, August is down 0.5%. September is down a little over 1%, which doesn't seem like a big drop, but you got to remember that's an average over 30 different years. There's going to be some positive of those years. There's going to be some bigger negative years. But if there was a pullback in the market, a lot of times this is the time frame that it happens. Kind of August, September, beginning of October. That's when it happens. So that's the weakest time of the year. But then as we go into the fourth quarter, you get the strongest time of the year. So this will possibly allow us to really evaluate the market and see if we get a pullback, as we go into August and September, can we maybe add a little bit to stocks if we still feel like they're going to continue to trend upward? Maybe that gives us an opportunity to add a little bit more cash. Also, and even more importantly, a lot of our clients and just a lot of people in general, were really scared about the market last year, and they increased a lot of their cash, money that they hold in savings accounts and in money markets. And money market accounts have been yielding much higher. So they've held a lot more, even above and beyond what we would normally recommend, which is just kind of your emergency reserves, maybe 3 to 6 months of your living expenses. So for those who have way more cash than what, a typical 3 to 6 months of emergency reserves, now over the next couple of months may be a good time to redeploy that, with the assumption the market will continue to trend higher, but you get a little bit of a dip for maybe a better entry over the next couple of months. So something to think about. Okay, so switching gears to a couple other asset classes. We've got some concerns this year about, some people talk about the digital dollar or the central bank currency of the US dollar coming out. What's that going to do to the dollar? And you got, countries around the world also talking about. So there's been a lot of kind of, I think it leans a little bit on the side of conspiracy theories, but people concerned about the dollar. Now, to me, the more important thing with the dollar is not central bank-backed digital currencies, but the more important thing with the dollar to watch over time, what has been a much stronger correlation, is where interest rates going. And if interest rates go up like they did last year, the dollar usually gets strong. It's a very strong correlation between the direction of interest rates and the direction of the dollar. So last year, the dollar was really strong. However, this chart looks at this year, and you can see the dollar, the dark blue line, is down 3.5%. And so it is coming back down. And I think part of that is the thinking that, the market is a forward-looking mechanism. It's always trying to anticipate the future. So if the market thinks that the Federal Reserve is close to peaking in their interest rates, which I have some charts on that in the bond section, then if interest rates are going to start to come down possibly next year, then the dollar would probably come down and get weaker as well. So the dollar has been getting weaker recently. It's down 3.5%. But I also show on this, a lot of times people say when the dollar gets weaker, we need to go all gold. And the gold can be a good diversifier with a weaker dollar. But interesting here, international stocks can also be a very good diversifier for a weaker dollar. So you can see when gold goes down, like the beginning of this chart, international stocks go up. And especially in this time frame over the last few months, with the dollar going down, international stocks have strengthened significantly. It's a very non-correlated or inverse relationship. So there are other areas that sometimes do better on a weaker dollar than gold. And international has been one of those areas. And if we are going to have a weaker dollar, that's a decent place to be historically. And that's an area that we've been adding to, over the last couple of years, as not only are international stocks decent in a weaker dollar, but their valuations are very attractive, historically speaking. They're at a large discount to U.S. stocks. So very similar chart, but now here we are comparing gold versus the dollar. Very similar non-correlated relationship or inverse relationship, where when the dollar goes down, gold goes up. Very similar chart. So gold going up as the dollar is going down. And gold is a good asset to own in a recessionary time frame, and also when interest rates are going down, or better said, when the dollar is going down. It could be a good hedge to a weaker dollar. And so it's something that we like to have in our portfolio during those times, inflationary times, times where the dollar is going down, and if we're potentially going into a recession, which happens a lot of times after the Fed raises rates a lot, or at least a slowdown. It's a good non-correlated asset that doesn't go up and down, usually at the same time as stocks and bonds. All right, so now switching gears to kind of going into the fixed income section and the Federal Reserve and interest rates. The big sticky part with the Federal Reserve or with inflation, or let me back up. Inflation in general has been trending up a lot. We heard about that, as we went into 2022. Big reason for the market to drop. Inflation really went up a lot. So this is the CPI, and the CPI is the dark blue line. The light blue line is the core CPI, which takes out kind of the more volatile food and energy prices. And you can see they both trend together. At its growth peak, inflation was growing at 9%, and that was kind of middle point of last year. That peaked and the growth started coming down. Remember, when this line goes down, it doesn't mean inflation is going down. It means the growth of inflation is going down. So we still have inflation, but it's growing at a slower rate. But now we're down to 3%. The Fed would like to see inflation, they measure it in a few different ways, but they would like to see it down below 2%. And if they think that we're getting close to there, that's when they start to stop raising rates and potentially even lower rates. But the sticky part has been housing and the labor market. So when you take out the food and energy, more volatile, core has been declining at a slower rate. And so core is still up at 4.9%. And in order for that to start to come down, you need to see kind of housing turn a corner, and you need to see the job market, which leads to wage inflation, start to weaken some. And while we're starting to see the turn of corner in those areas, we're not quite there yet, but I got some charts that I'll show you on that. This is US PPI and core PPI. And you can see these numbers have gotten a lot weaker. And you can see now your core is down to 2%. And just the PPI without core is down to 0. So a lot of inflation metrics are starting to get in a much better scenario for the Fed to stop raising rates and pause and even potentially lower rates as we go into next year. This has been the sticky part, and this is real estate. The chart we're looking at here is what's called the owner equivalent rent, year-over-year growth. So this is what rents are growing year over year. And so if you can picture, your own budget, for most people, the average kind of U.S. population or person in the U.S., the biggest part of their budget is housing, whether it be paying rent or whether it be paying a mortgage. And with interest rates going up and housing prices going up, landlords have been able to raise the price of rents. And so you're finally starting to see, after a really strong upward trend here, it's starting to turn a corner. And if you can see in this whole upward trend, we never really turned a corner and start to go down. But at the same time, we're still at a very high rate. Kind of the average here is a little bit above 3%. We're still at 7.8, but it has started turning a corner. And a lot of times that's what the Federal Reserve looks at, and the market in general, is not necessarily what the number is right now, but what is the trend. And if the trend is starting to go down, because you can see these trends kind of tend to continue going in the same direction until they do finally turn, and then they go in another direction for a long period of time. So the fact that that's starting to turn is a welcome sign for inflation. The last piece here, which has been good and bad. Good for the workers of the world, because the unemployment is at its almost all-time low. And so this is what this looks at is a 4-week moving average of initial unemployment claims. So an unemployment claim is when someone loses their job and they file for unemployment. Obviously, see this gigantic spike during the pandemic when a lot of people were forced out of their jobs and a lot of businesses shut down. And then this really long improvement in the labor market where you have very, very low unemployment. We reached 3.5% unemployment, which is the lowest point since 1969 in the last, over the last year. But if we zoom in on this this area here in this box and look at just kind of over the last 12 months, you are now starting to see unemployment claims trend higher. And recently they hit a new kind of almost 2-year high. But at the same time, kind of like the rental equivalencies, we're still coming from a very strong area. And we have a lot further to go on the upside before the employment picture starts to weaken. And not that we're cheering for people to lose their jobs, we're not. But from a historical standpoint, when the labor market is this tight and you have more employers with more job openings and people looking for jobs, which is still the case, then you have wage inflation, where employers are forced to pay their employees much more. And when people get paid more, they spend more. And that's a really sticky component of inflation and causes inflation to stay around for a longer period of time. All right, so I show this chart because this is a really interesting one. It kind of gives you the history of what the Federal Reserve has done in terms of the Fed funds rate. You can see back in kind of going into 2016, 17, 18, even into 19, they started slowly raising rates. And then they ended up peaking right around in 2019. Then you had the pandemic and they dropped rates super quick down to zero, stayed at zero for a long period of time, a lot of stimulation, a lot of printing of money and quantitative easing and sending stimulus checks to get the economy going, which then ended up causing inflation. And you can see just the, this huge amount of interest rates that they rose interest rates extremely fast and at a very sharp pace and really high to right now, they're at 5 to 5.25. There's almost 100% chance they're going to raise rates one more time. And so if you look at this gray line, which is when last time we spoke, it looked like interest rates were going to peak kind of right around that April to June timeframe and start to come down. But the economy has really strengthened recently. And inflation, like I said, on some of those charts, stayed sticky for a longer period of time. And with the market starting to go up again, the economy start to improve a little bit more. And even with there wasn't any more, from the mid-sized banking crisis, there was no more banks that failed. Confidence is coming back. And so that's caused the economy to strengthen, which has caused the Federal Reserve to raise rates a little bit higher. So now if we look at market expectations, that's this red line right here. And you can see this is where we were last time we met. They've pushed it forward where we're probably going to end up peaking after this next interest rate hike or next Fed meeting in July. Actually, I think it's next week. So that they're going to raise it most likely 1 more quarter of a point and then probably hold steady through the rest of the year. And in 2024, looks like they're going to start to lower rates. And as of right now, and it's, there's a lot of things can happen in this time period, but it looks like they're going to raise rates almost 1 full percentage point, possibly more in 2024. But it's really early to make that prediction. A lot of things can change between now and then. But that is what the market's expecting right now. And that's the probabilities. 1 more rate hike, 1 more quarter point rate hike, we pause, and then we start to come down. So with that being the case, with the market or with the Federal Reserve raising interest rates 1 more, a little bit stronger, the economy strengthened a little bit more, and then interest rates going up a little bit more than where we said last quarter, it's caused some bonds to pull back. So this is just looking at Q2 returns for bonds, and the most interest rate sensitive ones, like your long-term treasuries, pulled back 3.2%. You only had a couple bonds or a few sectors of bonds which are more linked to the economy, like high yield corporate bonds. Obviously, money markets are just steady, and then you have the emerging market bonds. Those were the only ones that were up over the last quarter. However, for the year, this chart's now looking at year to date, bonds are still positive for the year. In fact, the aggregate bond index through a little bit more than half of the year is up 2.7%, which if you annualize that, it's on pace to be, close to 5.5. So bonds have started to improve. They pulled back a little bit from their strength in the first quarter, but it does look like the Federal Reserve, their interest rates are starting to peak and come down. And when interest rates come down, bonds tend to do better. So looking at this next chart, going to get a little technical here and look at the technical analysis of yields. So this is the 10-year, the US 10-year US Treasury yield is one of the most followed of all the different bond yields. And so you can see this big drop right here, which was during the pandemic. In order to stimulate the economy, the Federal Reserve dropped interest rates a lot, plus the economy looked really weak. Interest rates typically go down in that time. And then as the Federal Reserve and the economy started to improve, you can see interest rates really went up. And then they peaked around October of last year. They've started to go sideways. So even though the Federal Reserve has continued to raise rates, yields of actual, bonds that are traded in the bond market have gone sideways. We've broken this trend line, this upward trend line. It's a support trend line. We've broken that recently right here, and it looks like we're testing it maybe one more time. But what I am watching here is from a momentum standpoint, there is an indicator called the MACD, which I'm not going to get in the technical side of what makes up the MACD, but the way you read it is when this black line crosses the red line to the downside, that's a bearish signal. You can see on the opposite side here, when the black line crosses the red line to the upside, that's a bullish signal. And you can see, yields went up during that time. You can see over here, another example, when the black line crossed below the red line, like it's doing right now, that's when yields fell. So we're just now starting to make that trigger point where the MACD is crossing. At the same time, you have confirmation of that within this trend line being broken. And you throw that on top of the Federal Reserve and what the market expectations are that we're close to peaking there and interest rates are going to come down in the future. That creates the case or builds the evidence behind, our thinking, which is bonds should start to do better as we go forward. Definitely better than last year. They have already started to improve from last year, but they could do pretty well as we go into the next year or two. And then the very opposite of the yield is the price of the bond. So this looks at the aggregate bond index, which has a lot of 10-year treasuries inside of it. But you can see this looks at, the bond price going down when yields went up last year. But now the bond prices have started going up as yields have started to come back down. That's broken an upward, or that's broken its resistant trend line, broken that down trend line right there, starting to in an upward trend. And you had the same signal right here, but a mirror image of it, where now this is looking bullish. The MACD crossed the red line. This is a long-term monthly chart. The longer term trends, when those happen, those are more significant. And so that is a good sign for bonds. And, unfortunately, there is no holy grail to investing, and there's nothing that can tell you exactly when anything's going to happen or tell you exactly when the direction of something's going to change. But what we try to do when we actively manage our client portfolios is build up a weight of evidence. A lot of different things pointing to the same outcome, and that increases the probability of that move that we make being accurate. But it's never 100%. I wish it was, but actually I don't wish it was. That wouldn't be any fun. But anyway, kind of the point here is bonds are looking much better. And while there's a lot of uncertainty going forward with the economy, if we did slow down an economy and we did start to go into recession, that would be very good for bonds. You would see stocks maybe pull back a little bit, but that would be a very good thing for bonds. So to wrap this up, both stocks and bond markets are starting to look attractive from a technical standpoint. Even from some macro indicators are pointing to that. Inflation is trending in the right direction, where still high inflation, core inflation has been a little bit sticky, but it's trending in the right direction. And the odds favor the Fed funds rate peaking this month and then start dropping into next year. So One reminder of something I pointed out earlier in the presentation, not only on the stock side, but on the bond side, looking much better. So for those that were really concerned and decided to go cash, or are holding a lot of extra cash and were hesitant to put that money into their portfolios, now it looks like a pretty good time where you could start deploying some of that cash as the stock markets are now, especially the large cap U.S. stock market, is into a bull market again, and it looks like the Federal Reserve may be peaking in terms of their interest rates as they start to come down. That's good for bonds. Remember, bond prices go up when interest rates go down, and that's starting to look like it's going to happen as we go forward. So with that, I'll hand it over to Paul, and we'll touch on a couple other things.
Very good. Thank you, Jason. As always, a lot of information, but hopefully very useful and relevant information for you as you do your financial planning and your investment management moving forward. So I want to encourage you again. I know we've had some questions coming in. Please feel free to continue asking any questions in the Q&A box there that we'll get to here in a second. But in the meantime, I wanted to just shift gears a little bit here and talk a little bit about some things that are happening at AllGen. Our team is growing. Okay, so some of you may have spoken to or seen or both one of our newest team members, Nora. So we'd like to give a warm welcome to Nora. Nora's our new client service specialist here at AllGen. She's a native of Hungary. You might notice that when you speak to her because English is not her first language. Okay, but she's also lived in Germany, Spain, and Colorado, and she moved to Orlando last year in 2022. So we're excited to have her. She has over 4 years of experience working in customer service and being a professional training specialist. And fun fact, she's fluent in 3 and quote unquote half languages, Hungarian, English, and Spanish, self-taught, if you will, and learning Portuguese. And she's also a foodie. So she's told us that she's offered, this is not why we hired her, but offered to make us some Hungarian food dishes to bring to the table at AllGen. So another team member that has joined us recently, we'd like to give a warm welcome to Axel. Axel is one of our newer financial advisors here at AllGen. Not new to the financial industry. He's experienced in investment banking, small business development, and has also been a business owner. So knows the different sides of the balance sheet and the profit and loss statement from a consumer, but also from a provider. Originally from Puerto Rico and moved to Orlando a few years ago, over a couple of years ago, with his whole family, wife and children. Fun fact, he says he loves God, spending time with family, sports, travel, and helping others achieve their financial goals. So again, feel free to join us in welcoming Axel to the team. Wanted to also remind you that we're always looking to increase our resources, be a great resource for you. So we have our dynamic portfolio investment review videos that you see coming out periodically, usually on a monthly basis. And those could be anywhere from the team, collaborative effort, or individually. We have Christina Schaefer, Jason Martin, and Ryan who head up those efforts. So be on the lookout for those, as well as our monthly investment management blogs, okay, that Christina Schaefer heads up. There's an example of one that's, your ultimate guide to the Fed now and the digital dollar. I think that came out just a couple of weeks ago. So be on the lookout for those. Again, resources. And as we asked in the beginning, please feel free to send us any topics that you feel would really help you. Because we want to make sure we stay relevant in the information we're providing to you. And a financial planning update quickly. Get ready for student loan payments to be due. We've had this deferment of student loan payments for the past couple of years, with the pandemic, et cetera, government trying to make it easier for people to manage their cash flow. But that seems to be coming ultimately to an end here in October, okay? May not be relevant to you, but it is a big deal. Because I'm sure if not you, someone who this is going to impact, because for the last couple of years, we've lived without having to make student loan payments. Okay, and now for those who have it, may see a hit to their cash flow, their monthly cash flow. So now's the time to revisit the spending plan, or someone make sure you're prepared for the payments to restart. We're always going to suggest high level to avoid the income-based payment route, which the challenge is this: you haven't been used to making a payment, so now you may say, oh, I have to make a payment. How do I minimize the impact? Well, you may do what's called income-based, but that may actually extend the life of your loan. And as most of you know, we preach eliminating debt, not extending it, because the longer your debt, the more interest you pay, And as Warren Buffett say, if there's interest involved, somebody's getting richer, someone's getting poorer. So we don't want you to be on the poorer side of that, or anyone that you know. So, here's some example of an original 10-year repayment plan, where you see that the loan term would be 10 years under the 10-year repayment plan, and the monthly payment would be higher, right? 1135. But the interest pay would be 36,258. But if people say, oh, that's a lot for me to swallow or stomach, well, let's do the income-based repayment plan where your monthly payment would drop. Now the loan term would go up to 20 years, which is what allows it to be less as far as your monthly payment. But look at the interest that you would pay over the life of the loan. Okay, more than twice. Okay, almost $79,000 of interest given away. Okay, so obviously this is a great time to revisit your plan, to maybe start looking at your spending and how do we accommodate to eliminate the bad part of your portfolio to really start building wealth for your future. And lastly, from a financial planning there's a few more things actually. If you're a business owner, if you know a business owner, and you file for a tax extension, which is coming up here in September 15th, you may still be able to make a tax deductible contribution into a retirement plan via SEP. This is, depending if you already have a plan in place. If it's not a SEP, it may have an issue. But of course, please reach out to your advisor. I know we're advising some of our clients that just the other day, we spoke with the accountant and said, yep, we can put this much on it. It's thousands of dollars in savings and tax savings this year that person is going to be able to capitalize upon. So the deadline is September 15th. The account would need to be established and funded by then before you submit your tax return. Okay, so if you have any questions on this, please feel free to reach out to your financial advisor, and we'll see how that can help you out. Okay. And one thing we want to also bring to light, I know if you've been a client for years or even recently, you have had access to a Morningstar portal. Okay, the Morningstar portal is a live tool that allows you to see your portfolio or your assets, your accounts that we manage here at AllGen. And I say live because it's usually up to date as far as the previous day. What's your account value, and it shows historical performance. You can sort it between 1, 3, 5 years since you've been with AllGen. We are actually switching gears when it comes to our technology. We're ramping up our technology to always make it better for you guys, to make it easier to see what's going on. Okay, and technology is always an evolving process. So we've done a lot of due diligence over the last 18 months. And our switching platforms, we're going to be moving from the current platform of Morningstar to an advisor portal called client portal called Advizon. Okay, it should give you a better user experience. It's improved reliability. One thing we saw with Morningstar is that it would blip out, temporarily unavailable. Our clients, you guys would tell us this. Now, that being said, we're in the process of transferring all that data, transitioning all that information. So as you can imagine, it's a cumbersome process, but you don't have to worry about that. Stay tuned. We anticipate this will be fully transitioned over by the end of this quarter, which is why I wanted to give you a heads up. Once it's fully operational, we will be reaching out to you, informing you how to log into your account, how to see your information with performance, allocation, returns, etc. Okay, so we're excited about that. Stay tuned for that at the end of the quarter. And then finally, as you guys know, every summer, the name is AllGen. We stand for all generations, trying to help all generations be better financial stewards. So we're happy to announce that our Money Sense Camp is going to be happening here in the next couple of weeks. Money Sense Camp 2023, it's already fully booked. So bad news is, if you haven't signed up, or if you know someone who would like to, we probably don't have room for you. We do have a waiting list, and we encourage you to always give us your waiting list, get your name or someone on a waiting list, because we have cancellations that always happen. We just had one yesterday. So the camp dates are July 31st, 1st, and 2nd. From 9 to 4 at Discovery Church, which is right off of Sand Lake, across from the Florida Mall. We look forward to seeing our future Money Sense graduates. We have some alum that are coming back to help and volunteer. We welcome volunteers. If you guys wanted to see what we do, we're always looking for clients or friends of AllGen to come and help us with these teenagers. There's activities. And we find that most of the volunteers are learning stuff too. Like, oh, I'm glad I attended. We don't need volunteers for all 3 days. We'll welcome you if you can make it, but If you stay for lunch, we'll feed you, all that kind of good stuff. So we're excited about that. That's coming up here in the next couple of weeks. Thanks again for all the support and encouragement to do that. So let's jump over to some questions in the time that we have remaining here. Again, please feel free to populate the Q&A section with any questions that you have, but I'm going to jump right in and let me see. I'm going to read one right here. Jason, you ready? Can I hear you?
Sure. Let's go.
Okay, very good. So question, well, you kind of touched upon this. I guess this is more what's happened, but what's your outlook on investing in real estate? That's always a hot question in these webinars.
Yeah, so real estate means so many different things, right? You have your house that you own, your personal residence. Some people have rental homes. You have publicly traded REITs. You have there's a bunch of different types of real estate. In general, if you're speaking of houses and rental real estate, we do think prices across the U.S. they have already peaked and started coming down. In the Southeast, in particular, in Florida and Orlando, where we are, it is starting to kind of round the corner, and prices are starting to come down a little bit. Rents are starting to top out, and after having a big jump over the last couple of years, they're starting to kind of top out too. So if you're able to buy real estate with cash, and you can create a pretty great big cash flow from that, net monthly cash flow. However, not too many people can do that because of how much the prices of homes have gone up recently. But to get a mortgage and to try to pay the mortgage at current days interest rates and try to still make income from the property, you're not having as much of a return now because of how large the mortgage payment is. But we do see that you may get an opportunity over the next couple of years with real estate kind of slowing down, maybe more openings, more people willing to sell. See, people just haven't been selling their homes because they don't know where to go with their next home. So the supply has been limited, which has also kept housing up. From our standpoint, when we invest in real estate in a stock portfolio or our clients' portfolios, you typically have to buy what's called a publicly traded REIT, which trades on the New York Stock Exchange or NASDAQ. And publicly traded REITs tend to be very leveraged, and they tend to have a lot of debt. And so when interest rates go up, that can be negative for REITs. It wasn't negative for our prices of our homes. That was a very good thing last year. And if you had rental real estate, that was really good because the prices went up. But if you're trading something that trades on the stock market that has a lot of debt, like most publicly traded REITs, that has come down. And that's been an area that's been lagging even this year. And it went down quite a bit last year as well. Now, here's the kind of turning point with those. As interest rates start coming down, that can be a good thing for publicly traded REITs because the amount of debt that they service and their interest payments may go down a little bit, which would increase their profits. So we are actually looking at publicly traded REITs. If we do believe interest rates are going to come down, that can be an area that maybe is a little bit better valued right now. It's been low. It hasn't really participated when the market's gone up recently. So it may be a buy low type of scenario. And typically those get a pretty good yield too. So it's a little bit of a mixed bag there, depending on which area you look at with real estate.
No, appreciate that. It's a timely conversation. I was having this conversation this past weekend with a realtor friend of mine, and she agreed. It's a tough time for most of us average investor consumer people who are trying to buy real estate to rent out as rental properties. Again, because of the appreciation that's happened and because of where interest rates are right now, if you're not paying cash for these things, it's very difficult to cash flow positive right now. But as Jason mentioned, things seem to be turning the corner if interest rates start coming down, in the next year or two, and prices start leveling off, but even coming down a little bit, could provide for some opportunity. So thank you for that, Jason. Question that came up here, what about the IMF predictions that global trade won't grow much over the next 5 years? Jason, I don't know if you're familiar with this thing there, but what are your thoughts on there?
Well, the pandemic changed a lot of things. You saw so many supply were issue when the whole government shut down across a lot of countries. People couldn't go to work. You just saw a lot of materials and supplies that you could normally get, you couldn't get to it. So when a lot of your manufacturing was being done in China, and then the ports are all locked up, or there wasn't as much transportation, or they weren't producing as much of that particular product, whether it's a semiconductor or whatever, the world ran into problems. And I think what the world realized is that you can't depend on one country or another country to supply all your manufacturing needs and just be able to import at all times from that country. So what a lot of countries are doing now is they're onshoring instead of offshoring, meaning they're bringing the manufacturing back to their own country. So when you do that on a massive scale, then trade between countries starts to slow down. It's not necessarily an indicator that global growth is slowing down, but it just means that countries are, especially the larger countries, the U.S., are going to onshore and bring a lot of the manufacturing and supplying of the semiconductors and a lot of the technology components that would normally come from China and other countries. They're bringing them back to the U.S. That also has some ramifications for inflation. So, a lot of times people do import from China as you can get things a lot cheaper. And so, if you bring it onshore, you're having to pay, much higher wages to the people that work in the US versus the average wage of someone in China. And that causes the price of those products to increase. So that's been another reason, and it could be from a long-term standpoint, cause inflation to stay higher than what we've been used to over the last 20 years. That's a very good question.
Very good. Thank you. I briefly mentioned this in the presentation, but the question that's there again is, the digital dollar. What are your thoughts on it? That's been a big thing over the last couple of years. Digital currency, digital dollar, Bitcoin, all the kind of fun stuff. So, Jason, keep telling. I know you've addressed this in the past, but what are your thoughts today?
Yeah. Well, quick plug for Christina and our blog. If you were to go to our blog and type that in, Christina just did a very in-depth article on that called Your Ultimate Guide to Fed Now and the Digital Dollar. I think a lot of people are concerned about this. The major concern is the privacy side of things, where they're concerned the government's going to be able to track their spending, and I certainly appreciate that concern. At the same time, the government right now can still pretty much track everything. So, if they can get into your bank accounts, they can track things if they had to. So I don't think that changes a lot. As of now, what we're seeing, even if we did have a digital dollar, which it looks like we are heading in that direction over the next few years, at least in the beginning, cash is not going away. And the actual fiat currency, the paper currency, will still stay around. That's yet to be determined in the long term if that eventually goes away. But I think the benefits of it, a lot of people are not paying as much attention to. I mean, if you think about it, and especially with the Fed Now move, which is what happened, over the last month, where basically they're just streamlining, which by the way, that is different than the digital dollar, but there's kind of this move to really make transactions, financial transactions, a lot more streamlined. And if you think about it, if I or a client sends a check in to us and it hits their Schwab account, or if we send a check to them and it hits their bank account, there's a 5-day hold on that check. So, that's just crazy. That's been around forever. I mean, even if you buy or sell a stock, it used to be 3 days. Now it's down to 2 days. There's 2-day settlement before you can get your money. You can only send money during business hours, and then you can't really send money on the weekends or in after hours. And it was came to this realization with my daughter, who's 16, and we use an app to be able to send money back and forth, and so she's used to this kind of newer technology, and she was talking about she was working and got paid, and she wanted me to transfer her that money, and I'm like, I'm sorry, honey, I can't transfer you that money because it's the weekend. They won't deposit the check until Monday. And so, but in her mind, it's like, what do you mean you can't deposit money on a weekend? Or what do you mean you can't transfer money on a weekend or after hours? Like, why is that? And that's a good question to ask. Why is that? We can't just accept, the way everything has been. We do need to get to the point where we can instantly transfer money back and forth 24/7. That's what the Fed Now does. And eventually, the digital dollar will have some of those same benefits, especially from international monetary exchanges, which now using this SWIFT system, and it can be convoluted as well. So we're not completely, I know a lot of people are really scared of it. We don't have that same level of fear as most. At the same time, we appreciate our privacy, but I don't see it as what I guess a lot of the conspiracy theorists out there see it. So I guess we're still a long ways off, probably still a couple years. Just so you know, other countries around the world, China, India, a lot of countries. In fact, inside that article that Christina wrote, you can see a map of the whole world and all the different countries that are doing this, and it's pretty much the majority of the world. So if we don't do it, we're going to be left behind because it makes international transactions. We just had a question about global trade. The global trade transaction is a lot easier when you can go to digital currency instead of going between two different, an old kind of convoluted SWIFT system. So, that's what's happening. If you really want to get the details about that, I encourage you guys to read that blog.
Yeah, I'm going to echo what Jason just said. Please read the blog because there's even some confusion which leads to fear, between the digital dollar versus cryptocurrency. Okay, which is not necessarily the same thing. The one is the other, but the other isn't one. So please read the blog, and of course, feel free to ask us any questions because I know there's a lot of people that have been burnt on Bitcoin, things of that nature, which is one animal, digital dollar, FedNow, different mechanism. One is centralized, one is decentralized, all that kind of fun stuff. Won't get into it here, but please, I would encourage you to read the blog and then, of course, come back with any questions. So I think that wraps up the questions that we have today. I know Cheryl had a question, but she said you clarified it. So thank you for that, Cheryl. And I want to just thank everybody for attending. Hopefully these are helpful. As you know, we send these recordings out to you usually within 24 hours. So be on the lookout for those. Thank you for attending, Jason, and for your presentation. As always, feel free to give us any feedback, thoughts, questions, concerns. We look forward to hearing from you, and have a great rest of your day. Thank you, everybody.
Yeah, thank you.